We're recording this podcast one day earlier. This is being recorded on Thursday, a day where stock markets are actually on the rise, but it's been 3 weeks now of general declines. Over the last couple of weeks I've been commenting upon how robust the market has felt in light of growing pressures on oil prices and obviously tensions in the Middle East. But the earthquake that happened on last week, the end of last week on Friday, the tragic consequences of that began to be felt on Friday developed further over the weekend with the nuclear reactor problems there, and that brought with it a whole host, I'm afraid, of uncertainties which stock markets never like, and of course as a result of that we have seen some fairly material declines. Let's take a look first of all at the impact on the Japanese stock market, which has been a good performer this year. There have been buyers. We had the Japanese index very much on our buy list this year, but it's fair to say that with the events and the complete uncertainties around there, certainly for anybody at the moment, it's probably safer to be out than in, unless of course you are looking to be in funds like the Neptune fund that is on our buy list, that invest very much in sensible export-led businesses there at the moment, which undoubtedly will have a very difficult time, but will survive and come through. But what we have seen here is the very sharp decline on the Nikkei. This is just a one-week performance. The two-day performance was the worst two-day fall seen on the Japanese stock market since 1987. I also wanted to just show the chart of the Japanese yen here. This is the yen versus the US dollar, and that, as you see, the dollar has slumped to really an all-time low there against the Japanese yen, and that's one of the things that the Japanese authorities, amongst all of the sort of real consequences of the earthquake, the monetary side of the situation, one of their big problems is the very strong yen. The concern is, of course, that a lot of money is going to have to be paid back into Japanese yen, insurance claims, money being repatriated, for example, back into Japan, and that's caused a strong surge in the yen. And of course, as a major exporting nation, a strong yen is the last thing they need at this stage, and there have been some words from authorities there to try and control that. But that is a chart that's going to be watched, I think, very closely over the course of the next few days. Obviously, what's happening in Japan initially, as I say, was not felt too bad in the rest of the world, in Europe and the US, but the nuclear fallout has really become the sort of major factor that is impacting on European markets. You can see here that the FTSE, it was the final straw after tensions very much elsewhere, has driven the FTSE down to that sort of 5,600 level that we see here. I would still argue that although markets are continuing to come back, they're behaving in a very, very orderly fashion, and they're behaving with that sort of mix of continued positive news on the economy. We're certainly continuing to see good earnings numbers coming out from businesses. We're still seeing good forward-looking surveys certainly coming out in the US at the moment. So those factors still very much remain intact, but I have to say the overlay of concerns to what's going on with the nuclear reactor, with information coming out on a sort of hour-by-hour basis, is the main thing that continues to influence on the markets at the moment. Some of the other sectors that do get impacted pretty hard in this type of scenario, this is the reinsurance index, and here you can see that it was very much one of the big casualties, as the cost of this particular insurance is expected to possibly move towards 30 to 40 billion. It's going to be a major hit for some of the reinsurers there, so that hurt. But other possibly more surprising stocks that were hit, Burberry, the luxury goods company, it's obviously been a fantastic performer over the last 2 to 3 years on luxury goods spending, which has particularly been driven by spending in the Far East, was probably the biggest equity casualty on the day of the earthquake. Japan does account for around about 12% of their profits, but they're a very fast-growing area for Burberry, and I think the concern there obviously is that they're going to have some profit warnings. I am seeing downgrades of about 6% for the luxury goods sector, so it's a highly rated stock and was bound to come under some pressure there. The other commodity that is going to be impacted probably more than anything else on the back of this is uranium. Uranium obviously used in the nuclear reactor. We've already heard news that China at the moment is going to at the moment not approve new nuclear stations, and this is really, as I say, has turned on its head the uranium growth story of nuclear energy going forward. This is a share price chart of Geiger Counter, which is a fund, very well managed fund here in the UK that is totally dedicated to uranium. And you can see that stock fell very sharply from 120. It's almost lost a third of its value, representing some of the investments that it has. Its biggest investment is Kalahari Minerals, that is in the midst at the moment of takeover talks with the Chinese, and as I say, some doubt coming in as whether that deal will be concluded has caused for many of their major investments to come under pressure. Also, just worries about some of the economic growth impacts that Japan may bring. They are talking about lower GDP, obviously for Japan in the near term. It is taking some of the metal prices down at the moment. So this is a chart of high-grade copper, and as you can see, that's really representative of many industrial metals at the moment. They are coming under some sort of pressure at the moment. That is reducing mining shares at the moment, and that's what's weighing a little bit on the sentiment to the market. All I will round up to say is that actually if we can see some of these stocks like oils and coppers and some industrial metals coming down, that will reduce some of the inflation worries that are here in the UK at the moment, and I think is pushing out interest rate expectations. So any thoughts of an interest rate increase in the UK for possibly May of this year, I think has already been pushed out to September, and I wouldn't be surprised if we still are in a similar situation by the end of 2011 with rates where they stand.